According to a study by the Credit Suisse Research Institute, 60% of family businesses reported revenue growth of at least 5% in 2011, proving that the family business model remains robust in the face of slow economic activity and the euro crisis. Mike O'Sullivan, Head of Thematic Research and Portfolio Strategy at Credit Suisse, is with us now. Mike, could you talk us through some of the key findings of the latest study?
Yeah, well, you started with performance, and you think what's happened the last 2 or 3 years. We've had the Eurozone crisis, the US has just been coming out of the global financial crisis. We're still dealing with indebtedness. So the performance of family businesses is actually very impressive. We've looked at it in 3 different ways. One, in the survey we've done on the members of the Family Business Network, companies actually report pretty healthy revenue gains. And in some respects, that's at odds with non-family businesses who seem to suffer more. Secondly, the Credit Suisse Family Business Index, which has been up and running for the last, I think, 5 years now, that's actually beaten the MSCI World, the equity benchmark, by 8% since then. So in terms of being an investor and looking at these companies, they perform pretty well. And then we've taken our Holt framework, which is the Credit Suisse proprietary valuation tool and database, and kind of dissected the performance of family businesses. And in terms of the operating performance and the value they create, that's also been pretty impressive. So, the credit crisis has been a difficult time, but on a relative basis, family businesses seem to have come through pretty well.
So why is it that family businesses have proven so resilient while other businesses have struggled?
I think there's a couple of things. One, the kind of sectors that these companies are in have been that bit less exposed to the business cycle. The companies we looked at in the family business survey, a lot of them are actually quite well established, 3rd, 4th and more generations. So they're actually pretty robust, and they've already gone through various business cycles. And I think also the other thing that comes out in terms of the investment philosophy of family businesses, it's very much long term. And the kinds of sources of finance that they tap tend to be longer term than rather trying to rely on short term financing.
And what are the factors related to management style that help family businesses succeed?
One of, I suppose, the kind of the broad assumptions people make, and it's in the literature on family businesses, is that they take a long-term approach. And we've actually dug into a lot of detail here with the survey. So we've looked at, say, payback rates for investment projects, which tend to be longer maybe than non-family businesses. And then you get into all the really fascinating kind of management issues, and at times you look at case studies, it looks like an episode of Dallas or Dynasty. So things like succession planning and doing that early and planning in advance, bringing along the next generation is important. As these companies get bigger, bring in outside help, outside executives, rewarding them and bringing them actually inside the decision-making process is one of the things that is actually very, very important.
So to sum up then, do you think this positive trend that we've seen this year in family businesses will continue in the mid or the long term?
I think it will continue for a number of reasons. One, the companies we've looked at are by and large well established. They are, we've looked at small, large, listed, non-listed companies, but they are, big companies. And I think the philosophy and the approach is so well ingrained across geographies. We looked at companies in 33 countries that I think it will endure.
And you also mentioned before that family businesses, or you looked at family businesses in the 2nd, 3rd, 4th generation. Is it harder for younger family businesses at the moment?
It seems so. If we've split, let's say, the 1st generation companies compared to 4th and older generation companies. And in areas like accessing finance, it just tends to be that little bit more difficult.
Thanks, Mike. For the latest research and publications from the Credit Suisse Research Institute, visit the website